Hey everyone, Paul Moore here from Wellings Capital, and so honored and happy to join the left field investors community again today to do another webinar. Today, we're going to talk about 7 strategies to build wealth in this weird and wacky economy. So, first of all, we're going to try to answer these few questions. The first question is, what's going on in the US economy right now? And I don't pretend to be an economist or play one on TV or give you a full answer for this, but we're going to hit that briefly. We're going to talk about how is impacting commercial real estate. And then third, most importantly, maybe we're going to talk about how should you and I invest to build wealth in this economy right now. So disclaimer, you can screenshot this and read this through if you want. Wellings Capital is not affiliated with left field investors, but we love each other and we support each other. And I'm so glad to be doing this. I don't know how many lunch and learns we've done, but I've done quite a few podcasts and lunch and learns. I am the founder and managing director, managing partner of Wellings Capital. I've written 3 books on real estate investing. I've been involved in Bigger Pockets and in the left field investors community for a long time. Most importantly, this is our 37th anniversary month, and we are celebrating that with our 4 children who still speak to us. It's amazing. So, without further ado, let's talk about the economy. Have you ever played tug of war? You know, it seems like the economy right now, especially regarding factors that are impacting real estate, is in a multifaceted tug of war right now, and it's impacting commercial real estate. So on one hand, there's significant hope that the Fed's going to lower interest rates. Hundreds of private, maybe thousands of private real estate sponsors, joined by thousands or maybe tens of thousands of their investors, are continuing to hold vigil through gritted teeth as they watch their distributions and long-term appreciation continue to evaporate. Hopefully that's going to change. On the other hand, we have persistent, dogged inflation that is raising operating costs on these same assets and keeping the Fed from making these hoped for, prayed for rate cuts. So, we exited 2023 with great hope for a whole bunch of rate cuts, and the market priced them into the 2024 pricing. But hopes for these multiple Fed interest rate cuts have been replaced with talks of higher for longer, and even some pundits saying higher forever. Sponsors' cries to survive till 25 are in many cases being replaced with pleas to survive at all. Now, those who hope to be saved by these multiple 2024 rate cuts have been disappointed so far, obviously. And recent inflation news hasn't done the trick. It just hasn't provided that relief. So, tug of war number one is between the hopes for rate cuts on one hand and persistent inflation on the other hand. There's also a tug of war between the operations in many multifamily assets and their investor-facing performance. By the way, in this presentation, I'm going to focus on multifamily because that is the data set that most of us are most familiar with and the one that has by far the most data out there. Now, after writing this humbly titled book, The Perfect Investment, I went on dozens of podcasts and wrote dozens of blog posts saying, hold on, time out. Multifamily is not the perfect investment. If you have to overpay, over leverage, use risky floating rate debt, and believe that trees, AKA rents, will grow to the sky. Multifamily boomed for years, but lately it's run into some trouble on a few fronts. We've seen massive run-ups in values and then this recent slowdown. Also, of course, a massive building boom, followed by this significant slowdown in starts. And we'll get back to that in a minute. For a moment, though, let's discuss the woes many of you investors have experienced in investing in multifamily these past few years. Most of us are familiar with the pain, but let's be really clear about why it's happening. Now, most of the problems with multifamily asset types right now are linked to debt. Some multifamily sponsors gamble by overpaying, using risky floating rate, short-term debt, and overly aggressive underwriting. Now, aside from slowdowns in rent growth, higher than expected insurance and operating costs, these assets are generally performing just about as you would expect. They're fairly normal occupancy, throwing off fairly healthy cash flow. So the problem is not with multifamily, let's be clear. It's with the financing that a whole bunch of operators did. It's not the asset class itself. And that's important as we think about how we're going to invest in a little while in this webinar. Now, there's another tug of war happening. And this one should actually make you very happy. I know that it makes me pretty happy. The commercial real estate boom from 2010 to 2022 was fueled by low interest rates, tax incentives, optimism, and a significant increase in access for many of us to invest in syndication because of the Jobs Act, the ubiquity of social media, and just basically the popularity of multifamily and syndicated investing. Now, because of long construction lead times, the boom is still going on in the building arena in multifamily. Look at this. Through the end of the year, we have this massive run up in newly opened apartments. They're called deliveries. But in fact, this Real Page expects that approximately 670,000 multifamily units will be delivered this year, which is the highest level since 1974, 50 years ago. But this boom in building is screeching to a halt. It's really changed this past year. The current high interest rate environment, higher construction costs, and delayed permitting have resulted in a dramatic slowdown in new multifamily starts. In fact, Pref, a reporting agency, reports that multifamily construction is ebbing with only 285,000 units started during the 12 months ending April 30th, which is about a 50% decrease from the year before. So building is slowing down. And of course, that makes total sense to us. That's what's going on the supply side. Now, what's going on the demand side? You might think, oh, demand must be way off too. Not at all. The National Multifamily Housing Council reports that demand still exceeds supply by a whole lot. A 2022 report from NMHC says that the U.S. needs to build 4.3 million more housing units by 2035 to meet the demand for rental housing. This shortage is actually not new. It started back during the Great Financial Crisis when we came up with a 600,000 unit shortage that's persisted since then. And now it's going to start growing again because of the previous slide I showed you that the building is now slowing down. The shortage is exacerbated by hesitancy of younger generations to buy. Also, the increased demand caused by immigration and other issues, and other factors like this huge next slide I'm going to show you, the cost of renting versus buying. Look at this. The cost of renting, according to Newmark, is actually $824 average less than owning a home right now. That's an 18.4 increase year over year, meaning the gap has increased that much. Simultaneously, purchase mortgage applications have declined to a 14-year low. Think about 14 years. That goes back to the middle of the Great Financial Crisis. Now, two large REITs, Camden and Avalon Bay, on their recent Q1 earnings calls reported startlingly low tenant move-outs in Q1 due to tenants buying a home. This is honestly great news for multifamily investors. Avalon Bay said the turnover remains well below historical norms, in part due to a low level of move-outs to purchase a home. During Q1, only 7% of residents moved out. This is extremely low compared to a 16 to 17% average quarter. That's people moving out to buy a home. Camden, which is a REIT in the Sun Belt, said 9.4% of our move-outs in the first quarter were for residents buying a home. This is the lowest in their history. They say that the monthly cost of owning a home today is 61% more than leasing an apartment. Think about this. How is this going to get resolved? I mean, rents are really high, but owning a home is much, much higher. Owning a home, that's going to come down. Will rents come down? I don't I don't see it. I mean, with rents being less than home ownership costs, and construction costs on homes and multifamily not dropping, mortgage rates will eventually subside, but will be enough to close this gap. If not, doesn't it suggest further upward pressure on single and multifamily rents? I think it does. Multifamily is looking really good. And again, I'm making that point as contrast to many of our experience right now, which is losing money in multifamily deals. Multifamily fundamentals are pretty strong. Let's look at a micro view, just briefly, of what's going on in multifamily right now. So first of all, immigrants have a propensity to rent. 55% are renters as opposed to just 42% of native-born population. But those who immigrated between 2018 and now have an average rental rate of 68%. That means only 32% buy a home. Record-breaking deliveries in Q1. New supply continues to break records as 135,652 multifamily units opened their doors in this quarter. It's going to continue to accelerate in Q2, Q3, and then before slowing down in Q4. And then we expect it to go back more toward the average as we talked about earlier. But meeting this supply is a huge increase in demand. 103,826 new units were filled in the first quarter. That's the largest first quarter absorption number since 2000. And it also outpaces the long-term first quarter average by 2.7x. In other words, it's a 170% increase over the normal absorption. So for the most part, new multifamily construction is being met by demand, but not everywhere. We see it really a big delta here in the Sun Belt. In fact, vacancies nationally rose 0.66% to a 5.9% vacancy average. So, and this also meant that quarterly rent growth has actually declined, not a whole lot, but 0.1% year over year in the first quarter. Multifamily debt originations fell to the lowest level since 2015. Investment sales volume has fallen to the same level as the fourth quarter of 2014. That's going back to, just after the great financial crisis. Multifamily expenses are on the rise, 6.5% up year over year. Now that's over double kind of the norm, and that's part of inflation, but it's also led by a 36.1% increase in insurance costs. That's the seventh quarter in a row where year over year insurance expenses went up double digits. Yikes. Now, bottom line, the medium to long-term outlook for multifamily investment is very strong despite these short-term issues, and the supply shortfall is growing again due to this current interest rate environment and lending environment coupled with chilly investor sentiment. And I think you all know what I mean. I'm trying to address that today. Now, some people think we just might have almost hit the bottom. Other people don't think so. Howard Marks, in his landmark book, Mastering the Market Cycle, Getting the Odds on Your Side, reminds us that we can't really predict the bottom or the top of any cycle. Instead, he encourages us to invest wisely where we are right now, given the data we have, given where we are in the cycle. So we ought to try to figure out where we are in the cycle right now so we can invest well right now. So where are we? Well, the answer might depend on your outlook. Now, where we are in the cycle is independent of your outlook, but how you respond to it might depend on whether you are a short-term or long-term investor and how you view these statistics. Whether you believe there are ways to make great investments in any phase of the market cycle, or whether you feel just doom and gloom. And a lot of people, a lot of short-term investors just feel doom and gloom right now. And I hope I really don't offend many of you, but honestly, many of the syndicators with whom many of you doubled your money and succeeded with over the last decade or so, they use short-term bets on the rising tide fueled by low interest rates and continually compressing cap rates. And I mean, they did really well. You did really well, many of you. But it was honestly bubble behavior and bubble results. And what is that? Bubble behavior and bubble results leads to great returns and then awful returns. And that's what a lot of people are experiencing right now. Let's face it, it's anything but normal to buy a value add apartment asset and do little to improve it and then double investors' equity by flipping it before the floating rate debt expired in 24 months. That's not normal. Many envision a cycle that looks like this. Now, this was reported by James Eng, E-N-G, and I really like his stuff. You ought to watch his stuff on YouTube. But it was illustrated actually by Ken McElroy. Many of you know who he is. It's a four-part cycle, and this is true for lots of different asset types of recovery, expansion, hypersupply, and recession. Now, if this is accurate, if we're really here in this hypersupply heading into a recession period, why aren't we seeing screaming multifamily deals like we did in the great financial crisis? Well, I would point out one big difference from the GFC to now. And that would be that a whole lot, hundreds of billions of dollars of equity is sitting on the sidelines, and it has been for up to 2 years, and it's got to be deployed. Now, this makes a lot of sense, considering the larger macroeconomics of a persistently undersupplied multifamily market facing steadfastly higher demand. What I'm saying is that it makes sense that money would be sitting on the sidelines waiting to pounce on multifamily and other commercial real estate because the fundamentals are there. Now, considering this larger macroeconomic reality, wouldn't we expect to see some longer-term investors acquiring multifamily assets, even with interest rates where they are now? Well, we've recently seen exactly that. If you've been watching the news, Blackstone's made two large acquisitions. Recently, they acquired Air Communities for $10 billion at the beginning of this quarter. It was April 8th, I think. Now, while some see this on one hand as a signal for the start of a new phase of the market cycle, for most buyers on the other end of the tug of war, persistently high interest rates are holding them back from following suit. Now, there's pretty good reason not to be investing for a lot of people in multifamily right now. I mean, look at this. The margin between the risk-free treasury rate and the cap rate has shrunk to, I would say, an alarmingly narrow margin. Now, if you look at this, multifamily cap rates have gone up a little bit during this last 2-year, we'll call it interest rate hike crisis, while interest rates have gone up a whole lot. So the spread of 4.3%, 430 bips, has narrowed to 160 bips. It's kind of shocking if you think about it, because it's sort of similar to 2006, right before they had a big crisis. And it shows that people are still buying and taking a lot of risk when they buy. In fact, You could argue that the risk right now with interest rates where they are is actually maybe even higher than 2020 or 2021. Now, I will say that one factor that's better right now is this. At least buyers who buy today can refinance at lower rates. And that wasn't in the cards in 2020 and 21 when rates were so shockingly low. But I mean, let's face it, once you add the spread, when mortgagees are getting mortgages now, operators are getting mortgages, they're actually in the negative leverage category, which is not a great place to be. It's actually quite speculative. So, everything we talked about, this is basically an overview where we are in the economic cycle right now and how it affects commercial real estate, particularly multifamily. So now let's address the question you all came for, and that is, how then shall we invest? And what I'm going to do now is give you one slide that's a quick overview of the rest of our talk today. We're going to talk about investing with a long-term view. We'll talk about investing in historically recession-resistant asset types, recession-resistant asset types with some examples. We're going to talk about the potential to shift your position in the capital stack for a better risk-reward ratio. We're going to talk about investing in special situations. We're going to talk about investing in intrinsic value plays in any economy. And sort of as a bonus, we're going to talk about low correlation and high diversification, as well as going for boring. So if you're not bored yet, I'm going for boring here. Okay, let's jump in. Number one, invest with a long-term view. Investors with a long-term, bigger picture outlook can often find better opportunities in soft markets like this. Now, I discussed multifamily sector's long-term supply and demand challenges earlier. I also mentioned Blackstone's two big acquisitions this year, and they specifically considered big picture economics when they did that. In fact, Blackstone's Q1 earning call was very instructive, hearkening back to their strategy of acquiring housing assets during the middle of the great financial crisis. They discussed deploying capital in periods like 2009 to 12 when other investors were being cautious. And they cited the recent 50% decrease in multifamily starts. Here's what they said. I want you to see this. They said, we're planting seeds of future value in what we believe is a favorable time for deployment. From our perspective, because we're buying assets so often, here it is, for longer periods of time, the fact that a rate cut may happen in 90 or 180 days is not really a long-term negative. And if anything, it allows us to get better deals. Specifically, he says it allows us to get into some assets at more favorable pricing. And I'm going to give you a fun example of this in a few minutes, in addition to Blackstone. So we've got the supply and demand long-term imbalance. We got Blackstone's purchase and their comments on the earning call. I personally think that many of the smartest commercial real estate investors are bucking today's norm by choosing longer term holds. My company's doing that. We're buying, we're investing right now. And our investors apparently see things similarly. And we are honestly doing really well during this, challenging time. Now, the long-term view, as you may imagine, includes not only the way we structure the deal, but also the debt. We talked about how much debt is causing problems. Long-term holders typically acquire with fixed rate long-term debt. And the vast majority of assets in our fund, for example, are generally using this type of debt. So before I go on, I want to talk briefly about how the wealthiest of the wealthy invest. And we're going to hit this a couple more times in the rest of this webinar. I think it's really interesting. So I actually, by the way, stole this slide straight from my June 12th LFI Lunch and Learn on hold times, comparing IRRs, and illiquidity. I think you'll really enjoy that. So wealthy investors, savvy investors, institutional investors share an apparent bias toward illiquid investments and corresponding long hold times. Of course, they invest in liquid market investments too. Now let's examine Berkshire Hathaway. That's Warren and Charlie's company. Arguably, they're the savviest investors of the past century. Now, Berkshire Hathaway has created its own illiquidity. In other words, they're going to hold long term in two different ways. First, they have full ownership of a lot of companies. They can't just sell pieces of these, they can't sell shares of these. They're locked up for years or decades. Secondly, Buffett and Munger have created effective illiquidity through self-imposed discipline. They plan to hold stocks and companies for a very, very long time. In fact, Buffett said, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. I love that. Buffett also said, our favorite holding period is forever. We're just the opposite of those who hurry to sell and book profits when companies perform well, but who tenaciously hang on to businesses that disappoint. Peter Lynch aptly likens such behavior to cutting the flowers and watering the weeds. I love that. Buffett also quipped, successful investing takes time, discipline, and patience. No matter how great the talent or effort, some things just take time. You can't produce a baby in 1 month by getting 9 women pregnant. Wow. All right. What about Charlie Munger? Well, Charlie Munger, God rest his soul, had something to say about long-term holding as well. He said, the big money is not made in the buying or selling. It's made in the waiting. Think about that. So our first premise today is to invest with a long-term mindset and with long-term actions. Our second premise is invest in recession-resistant assets. Now, Newmark reports that the number of affordable housing units, those renting for less than $1,000 a month, declined by 4.7 million from 2015 to 2020. Now, we've often stated that manufactured housing communities, which is mobile home parks, are the only asset type we know of with a decreasing supply and an increasing demand pretty much every year. Investing in historically recession-resistant asset types like this, with a long-term view, which was point one above, especially in an economy like this one, can provide even more favorable outcomes. Now, I want to tell you about an example from one of our operating partners. This is a friend of mine. He's a mobile home park operator. He offered $5 million for a pair of mismanaged Detroit mobile home parks in 2023. $5 million was a screaming deal for him as a buyer, had a lot of upside. But the seller said no. They didn't want to take $5 million for it. They said, we want a better outcome. So the owner went and it took some time and he placed these assets on an online auction site. Now, the previously overheated mobile home park, just like everything else, had cooled more during that year, but it's not because of supply and demand. Okay, it's recession resistant in some ways, similar to multifamily, maybe more, but it had cooled due to the macroeconomic issues we've been discussing earlier. And so our partner found this pair of assets he had bid $5 million for on the online auction site, and he bid $3.1 million, and he got them. Basically, it came out to $8,500 per site, which is unheard of low price. Okay. So, I mean, almost as surprisingly, the operator has identified one two-part utility strategy dealing with water, sewage, and other utilities to increase the net operating income by $320,000. This is without raising lot rents. Okay, so he's increasing his NOI by $320,000. And if you know the commercial real estate value formula, the value is the net operating income divided by the cap rate. So at the same cap rate, let's say at a 6.5% cap rate, A $320,000 NOI hike means an on-paper asset appreciation of about almost $5 million. Remember, he paid 3.1. And he plans to do a whole lot more, including bringing in new homes to fill vacant sites, improving the properties that had fallen into disrepair, a lot more. So here's the point. Mobile home parks are performing as well or better than ever. The growing shortage of affordable housing persists even in a somewhat stalled real estate economy. Macroeconomic factors apparently kept other bidders away from this deal at the online auction and actually allowed our friend to get a much better deal. Let's boil it down. So our partner bought an asset that was unaffected by the economy at a price that was affected by the economy. Let's say that again. The operator bought an asset that was unaffected by the economy at a price that was affected by the economy. I love it. It reminds me of another quote from our friend and mentor, Warren Buffett. He said, "Price is what you pay and value is what you get." And he bought a lot of intrinsic value in this mobile home park, this recession resistant asset. Here's a picture of one of the pair of parks in Metro Detroit, not far from where I used to live. So the point here is invest in recession resistant assets. Why? Because their performance often continues to be stable or improve, while their price is sometimes discounted at times like this. Doesn't that make sense? Number three, consider shifting your position in the capital stack. Now, the commercial real estate sector has settled into this higher rate environment with, players coming to terms with the Fed's higher for longer policies and substantially higher all-in costs of capital. Now, we're going to discuss one move in the capital stack that we've made. There's a bunch of things you could do. You could switch from common equity to debt, or you could switch to mezzanine debt, or you could do what we've done and switch to preferred equity. So we believe preferred equity has better priority and safety, provides better risk-adjusted returns, in our opinion. There are 4 types of pref equity. We're going to discuss that. We're going to talk about how you can invest in pref equity. And as I go through this, I want to point out that this is just a very quick summary of 2 other lunch and learns that I've done for LFI. I think one was in late 2023 and the other in early 2024. So go check those out if you get a chance. Was talking with our two of our very savviest investors with our company. This is his office in San Francisco. And he said, get all of the preferred equity you can possibly get until the time clock runs out, because he said it will run out. But while you can get it, grab all you can get. You see, it's ironic. Higher interest rates tend to generate lower returns for common equity investors, but they result in more opportunities and higher returns for preferred equity investors. So while we still like carefully underwritten common equity deals, we feel that pref equity is a great place to be at this point in the cycle. You can see pref equity here is in the middle of the capital stack. It's got priority ahead of common equity, and it's, of course, behind senior debt. So it shares some of the advantages of debt and some of equity. It's got payment priority ahead of common. It's got lower downside risk exposure than common equity. There's no lien, but often we get a personal guarantee from the high net worth sponsor. We get more upside and tax benefits than debt, and we really do believe for me, it's the sweet spot right now with a very compelling risk to return ratio. So what's so compelling about pref equity? Well, again, we went over this in a lot more detail earlier, but it's got immediate cash flow and future upside. It's got shorter hold times typically. It's got a chance to get depreciation, just like common equity. We've got leverage with operators. We can get all kinds of wonderful terms because they really need this pref equity. And it's got superior coupon, which is rate of returns for small check sizes. So the window for this right now is very much wide open. Access to capital scarce. Uh, there's, valuations are down. There's market uncertainty. There's fearful investors. And honestly, right now, the coupon rates, the total returns are really attractive. And I already mentioned that higher interest rates are depressing common equity returns. They're giving a better opportunity for mezz debt, pref equity, and other similar financial vehicles right now. They're giving us a better opportunity for more deals and higher paying deals. And more operators are embracing this. But this window is eventually going to close. When interest rates go down, banks will kind of return to normal. Sponsors will be able to refinance. They'll close that gap. They'll be able to basically raise capital like they did in the past. But even before this window closes, we've got to face that, this opportunity. There's a lot of other players coming in to the small, under $10 million check size. And that drives down the current pay and coupon rates that we're seeing now, or at least we think it will. Now, a lot of people think that preferred equity is just rescue capital, and I would just beg to differ. There are four types of pref equity. The first is for acquisitions, and we've done deals like this. We love these deals, but we love even more the opportunity to do recapitalizations because these are properties that are already owned and they generally, should be more predictable, lower risk properties. There's also opportunities to provide pref equity for development. This is obviously higher risk because development's higher risk. And then speaking of risk, there's also rescue capital. And our company, I'm not knocking anybody doing pref equity as rescue capital, but it's just outside of our risk tolerance, especially when we can get deals like I'm going to show you next. Now, just to be really clear, this opportunity is not available for investment anymore. We raised $6.5 million for this pref equity investment. It was a recapitalization, so we like that. We got all kinds of special rights like forced sale rights, capital improvements, holdback, and annual budget approval, and more. Had downside protection because there was 27% of common equity. And, so the asset could be devalued by 27% or so, and it wouldn't touch our position. We got depreciation, and we offered target net average annual returns of 6.5 to 8%. That's ongoing cash yield, almost out of the gate, and 14 to 15% targeted overall returns. Again, this is not available anymore, but these are the types of deals that are being done right now. Now, our total return at our company level was higher than this. This is net to investors in this one situation. So, speaking of situations, I want to talk next about special situations. Now, we really like moving our place in the capital stack, but we also like investing. We also like investing in deals where you can find a very unique or special situation. So we really like the medium and long-term prospects offered by multifamily, as we've said. But unfortunately, as we discussed above, the sector's still overheated, and brokered deals are often coming out with negative leverage, as we've talked about. The cap rates just have not gone up enough to match the interest rate increase. Most of these deals have a very low margin of safety, and that's expressed as the debt coverage or debt service coverage ratio. And we're just uncomfortable with the risks in this arena for the most part. So in addition to the preferred equity investments we've made in multifamily, we are achieving respectable targeted risk-adjusted returns by investing in tax-abated multifamily opportunities. In fact, one of our recent allocations was into a Texas multifamily deal. It was acquired for about $80 million by our operating partner. And it was that was about $26 million in equity and the rest in long-term fixed rate debt. Now, they got a 99-year tax abatement from the local city in Texas. And they, for this asset, for this property tax abatement, abatement, the appraisal came in $113 million on the day of closing. Remember, they just paid $80 million for it. It was valued at $113 million. This is a $33 million increase. That represents about 127% theoretical gain on equity right at closing. And, since we're discussing margin of safety, I'll tell you it all also provided a very significant increase in the debt service coverage ratio, or the ongoing margin of safety. So this is the asset. We talk about buying and investing in value add older multifamily. This is pretty new. And so we really encourage investors to seek out these special situations. This was created by the government in Texas. This was, it's sort of a dream come true for people who can pull this off. In this economic environment, in fact, in every economic environment, we encourage people to look for things like this, but more specifically, we're recommending people look for intrinsic value plays. Now, Warren Buffett and Charlie Munger claim they never had a substantial conversation about the economy when making an acquisition or disposition decision. In fact, they were always looking for intrinsic value. They said they were looking for three things. Number one, they simply looked for durable products. Number two, managed by skilled managers. Number three, at prices well below value. That's their formula. That's their investment criteria. We recommend a similar criteria for you. We recommend that you look for recession-resistant asset types acquired and managed by outstanding asset managers at prices well below their potential value. So our funds, we attempt to do this. For instance, we just got an update on an Iowa mobile home park that's actually in several of our funds. This 424 site park was acquired in December 2022 for $8.5 million in cash. The operator passed utilities back to tenants, which generated $235,000 in net operating income annually. Now, using our formula we talked about before, 235,000 divided by about 6.5% cap rate, 0.065, provides a $3.6 million on paper appreciation. So that's the intrinsic value. The operator saw that most large parks pass their utilities back to their tenants. You pay your own utilities, I pay mine. It's just the best. It's best for the environment. It's just normal. Well, that wasn't happening here. And they also saw that there were a lot of vacant lots. And so they've already brought in 11 new manufactured homes in this year and a half. And they created an additional $812,000 in appraised value from the income from those homes. They've also improved the quality of life for residents by paving roads and undertaken quite a few deferred maintenance projects. So in under 18 months since the acquisition, my friend achieved, get this, a 28% increase in revenue and a 57% increase in net operating income. Now, this asset was recently financed for the first time, and they pulled $8 million out. Remember, they only paid $8.5 million for it. And they pulled that money out to pay down their lines of credit and to invest in other assets. So again, this asset, this is it, by the way, that's the original view of this park. And that was before these beautiful new paved roads in this same park. So Intrinsic value. It's basically when you can find an asset that has more potential value than shows on the surface, more potential value than the current owner sees. An example would be buying a self-storage facility with 6 empty acres out back. The seller says, yeah, I never really use those. We just have this 1.5 acres of units up front by the road. What can you do with that out back? Well, you could gravel it or pave it, and you could use it for boat and RV storage or outdoor industrial equipment storage or all kinds of other things. You could add a billboard. You could add a cell tower, perhaps. You could add a propane filling station. You could set up a store to sell locks, boxes, tape, and scissors. All kinds of intrinsic value when you own the asset. Um, let's say you owned a mobile home park and you had an acre or two out front. You could pave it and set it up as boat and RV storage. It cleans up the park and it allows people in the community to have a place to store their stuff, but it actually could create, literally, I know one example where it created like $2 million in additional value because it basically rented the spots in that outdoor leasing area for about $10,000 total a month. That's $120,000 a year. Divide by a 6.5% cap rate. That's almost a $2 million increase in value. Quite impressive. So we really do recommend looking for intrinsic plays in any economy. We're talking about asymmetric opportunities where there's much more upside than the price you pay. We talked about Buffett's comment on that before. Buffett loves the efficient market hypothesis. Did you learn that in school? I did. I learned it in my business school, and it basically said there's no good deals. Everybody's eyeballs are on every stock. So there's really no good deals. Everybody has the same information, millions of eyeballs, lots of people trading it every day. Everything's priced right where it should be. Is that true? Well, Buffett says he loves it because so many people believe it's true. And it is true for most people. But we're not as good as Buffett and Munger. But they've got a very, very hard place to play. They're playing, I mean, one of the reasons they have 150 billion in cash on hand is it's very hard for them to find places to invest. And, that's the problem with public equities. Real estate by nature has a lot better good deals. Wait, did that sound right? A lot better good deals. I need to go back to English class. Anyway, it's got a lot more good deals. And real estate does, and venture capital does as well, because the assets are harder to evaluate. They're harder to precisely price. And there's a lot more great deals and probably a lot more awful deals as well. I recommend investors go for undervalued mom and pop value add opportunities. They can often acquire these assets with significant intrinsic value. I've just given you a couple examples of these in the form of mobile home parks. The value is typically only mined by operators or investors who forego the instant gratification and liquidity of public equities, and they embrace illiquidity. Now, these illiquid assets are often ripe for skilled operators who know how to mine the value out of them. And this is just really hard to find in public equities. I mean, Buffett's been a master at doing this, but it's not common and it's very, very difficult. I've often thought that Warren Buffett would have been a happier, more profitable investor if he would have invested in real estate rather than public equities. Of course, we'll never know because he's not a real estate investor. I think he should have been. Now, I just covered 5 ways to invest that I believe are particularly well suited for this weird moment in the economy. I've got 2 more. These last 2 are ways I believe we should be employing in any economy. And I'm guessing most of you left field investors are already doing this, or you already feel the same. But the next one is low correlation and high diversification. Now, most of the slide's obvious to you, but I wanted you to have some fodder when you talk to your potentially narrow-minded financial planner, or when you're defending yourself to your relatives around the Thanksgiving table. So passively investing in commercial real estate means we are investing in assets that have a very low correlation to the stock market, regardless of their underlying operating performance. Liquid public equities are subjected to the mood on Wall Street, a CEO scandal, a war in the Middle East, or a random CEO tweet, Elon Musk, or they're just going, they're basically, it's the mood of the market. It's not really the operating performance that is driving the price and value. So investing in commercial real estate often largely avoids these landmines. Now you're investing in illiquid assets, but that's a benefit. It's not a downside. It's actually a benefit. And I'll show you that more in a minute. Diversification is also important. Now we believe in investing in diversification for safety. I'm seeking diversification across asset types and operators, geographies, strategies, and properties. And as I just spoke about 5 minutes ago, I also now want to diversify within the capital stack. Now, I mentioned illiquidity. Illiquidity, I have thought for years, is a downside. I thought for years it was a liability, but it's not true. In fact, that super successful hedge fund manager I mentioned earlier in San Francisco said that if he only had illiquidity, he could generate returns in the mid-teens. Because he invests in public equities, he said he would be really happy if he could get a 9% annual return in his hedge fund. Happy with 9%. But he also mentioned that we would be really unhappy if we got 9%. And he said that's the benefit of illiquidity. And when he said that back in May, a year ago, it really got me thinking and talking and reading. And I actually wrote a blog on that. And I'm going to give you this blog post address before we're done here. But I also, on June 12th, released a lunch and learn that talked about confusing IRRs, hold times, illiquidity, liquidity. And I really hope you'll check that out. So this slide is from that talk, and so is this slide. I love this chart. Look at the investment allocations from high net worth versus ultra high net worth investors. This graphic was created, by the way, originally by Origin Investments, and it's based on data from KKR. Now, note that ultra high net worth investors have almost twice as much invested in alts as just high net worth investors. And they've got about half as much in bonds and only about 60% as much in stocks as their high net worth counterparts. I'm talking about ultra high net worth people here. Now, dialing in specifically on alts, this second set of columns, these include a wide variety of asset types. But which type do the very wealthiest investors prefer? Knight Frank did a survey on this. They called it the Wealth Report, and it reports that ultra high net worth investors prefer real estate as their top investment choice by a very high margin. So, like I said, you know all this, but I'm just giving you fodder to talk to your golf buddies who are trying to lure you back into Wall Street casinos. So, now you've heard me say this before. If you've seen my other lunch and learns, I talked about, investing in boring assets. Shiny objects are alluring. It's easy to get excited about jaw-dropping IRRs and short-term investments. But Paul Samuelson, America's first winner of the Nobel Peace Prize in economics, said investing should be like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. Let's remember our true goal here, and we're landing this plane finally. Aren't we really just trying to build wealth? Aren't we trying to build true wealth? What is true wealth? True wealth, I would define as this: having assets that reliably produce cash flow. If you have assets that produce cash flow, you have true wealth. Well, I really appreciate the opportunity to be with you today. I want to give you a few pieces of contact information. You can book a call with me here at this top. You can screenshot this. You can learn about how we are investing in fighting human trafficking at aimfree.org. That's our partner that we try to direct donations to. We've raised over $600,000 in less than 3 years for aimfree.org. You can get special reports, wellingscapital.com/resources. You can email us. And I really want to, again, encourage you to watch the June 12th Lunch and Learn and read this blog, wellingscapital.com/blog/power-of-illiquidity. I think you'll find it fascinating and helpful. Thanks again. Thanks for joining me today. Thank you for taking this time. And I hope that if you enjoyed this presentation, you'll get back to our friends at Left Field Investors and let them know. Now, I'm really, really grateful for all of you. And I really hope to see you again at the next Left Field Investors event. Thanks. Have a great day.